Hey guys, welcome back to Generous Lifestyle with me, Lyle Weber. In today's video, we are going to be talking about mutual funds, index funds, ETFs, and you might be wondering, what is he talking about? Well, stick with me until the end of this video, and I'm sure you'll have a better understanding of what they are and which one you should be investing in. So let's hop on straight into today's video. So let's start off with mutual funds, or the way I like to think of it as collective investment schemes. And the reason for that is years ago I was an auditor and I audited collective investment schemes, also known as mutual funds. So what a mutual fund is at a really high level is it's the pooling together of funds. So you have lots of individuals who come and they bring their money to somebody who's going to manage their resources or their funds to help them build wealth. Let's call this person asset manager. So I bring my money, you bring your money, that person brings the money to this person then goes out and identifies what they are going to do in order to generate a particular return for us. So they take our money and they then go and invest it. They buy into different asset classes. So they buy equity and they buy property and commodities and bonds and the like. So they got and they do it for us, as opposed to me going and buying stock in individual companies or being the borrower when it comes to bonds. Actually the lender, because I'm lending unto them, they are borrowing from me. So when it comes to those sort of things, so instead of me going out to all of these organizations and trying to buy or to lend unto these organizations, I come to this particular wealth manager or asset manager, and they in turn go out and they go and invest for me, and in return they try and achieve a particular return for myself. Okay, the one thing with that though that I'd like to point out over here is that there are fees associated with that, because they are actively managing the portfolio. Their job is to identify where to take my money and where to put it in order to get me a particular return. They can't guarantee that I'm going to get a particular return, but they're going to do their best, because the better they perform, the better their commission is at the end of the year, or the fee that they get, because generally it's a percentage base and it could be as high as 2% of the value of your investment. So let's say you've got 100,000, the value of your investment at the end of the year, 2% of that, 2,000. Might not sound like a lot right now, but let's say that grows to $1 million. Let's say it grows to 2 million and you multiply by 2% if it's slightly higher. All of a sudden, we're starting to talk about real numbers. It's actually going to take away from your bigger portfolio or your asset base itself by paying somebody a fee on a year-by-year basis. It's not a once-off fee. I do believe that these individuals are skilled and talented individuals, and they should be paid for their services rendered. So I'm not saying you shouldn't go with them, but I'm saying just bear in mind that there is a fee associated with it. The other thing with a mutual fund is that there's something called diversification. So they might say that they're going to take your money, they're not going to put it all into equities or all into property. They might have a particular portfolio that is more favored towards one of those, maybe 40% in equities, 30% in property, and so on. So there's maybe more of an inclination for a particular season to put more of your money into a particular asset class. But for the most, they are going to diversify your investments so that if there is something that negatively affects a particular industry or sector, that you are shielded for the most and that you don't lose all your money. Index fund. So what is an index fund? An index fund is a mutual fund. So it's also you coming and you are putting your money into this particular fund, but the difference is it's not actively managed anymore. It is passively managed because there are formulas that actually track particular indexes. And what an index is, it is a method to track the performance of a group of assets or securities. So what does that mean? So I said it's a method to track the performance of a group of assets or securities. So common example is the S&P 500, which is the top 500 companies in the States, right? So you could have an index fund that tracks the top 500 companies. So if the top 500 companies collectively perform at a level where they increase in value by, let's say, 10%, the index will track that, and you should be expecting to get about close to a 10% return on your investment. There are fees, however, associated with this. Some index funds might have something called a load fee, where you pay a commission at the start when you buy into this particular investment or into this index fund. So that's called a load fee. Some of them might have a fee at the end of the investment when you cash out. And there's also going to be an annual fee. Remember, we said with the mutual fund where it could be up to 2% or maybe even more than that. These are generally in the range of 0.2%, but it might be a little bit higher at times. But even then, 0.2%, so for every $1,000, that is only going to be $2. You see the difference? So $2 on $1,000 on 100,000, how much is that? You do the math yourself. Okay, and then let's look at ETFs real quick. ETFs are really similar to an index fund in that it also could track a particular index or group of assets, but the difference between the two is with an ETF, you can buy and sell during the course of the day like you're buying shares. Okay, so you could go on to the particular exchange and I could buy an ETF today at 2 o'clock in the afternoon or at 3 o'clock, whereas with a index fund, I can only do it at the end of the trading day. So you can do it once per day. The fees with the ETFs, they might be lower than the actual fees with the index fund. So you got to just weigh up the two. There's also no load fee with an ETF. So when we said with the index fund, you get the load fee and you get the annual fee, which might be 0.2%. With the ETF, there is no load fee. So if you factor that in, ETFs are more often than not cheaper, purely on the basis that there is no load fee. And then there's also other tax implications, which we are not going to go into right now. So you need to just do your research just to see what the tax implications are between the two of those. And the final thing that I wanted to point out between an ETF and between a index fund, which one is the right one for you? Only you can decide that. You are the person that needs to determine which one I prefer being more comfortable with. For me personally, I prefer index funds because I'm in it for the long run. I'm not somebody that wants to go out and monitor what is this ETF looking like today. So maybe I should take money out because I'm going to be tempted to maybe move the funds out of that ETF. Whereas with the index fund, I know it's going to track the S&P 500, which I'm okay with. Just putting my money in on a monthly basis and letting this thing being my investment track this particular index. Last thing that I want to point out, and here's a bonus point for you, is look at the different index funds or ETFs that are out there. They might all be tracking the S&P 500 or a particular industry, but they carry different fees. So make sure that you're getting the one that has the best fee structure for you, because even a 0.5% difference between the two and they're both tracking the same index could mean the difference between you getting to a place of financial freedom quicker and sooner rather than later. I hope this helped you guys. Comment below if you are a person that prefers ETFs, mutual funds, or index funds, and also your why. Let us know below by commenting. And then again, if you haven't clicked that subscribe button, click subscribe right now. And share this with family and friends that you believe can benefit from this information on this channel, because I believe that together I will share some information with you. And I say we because as I share information with you and you commenting on the videos, I see what you want to know more about and where you are, so I can help you to walk out this journey of financial freedom.